I'm comfortable enough to send pre-approval letters in those circumstances. Again, we don't want to make a habit of it, because if that offer does get accepted, or if that offer is being entertained, I should say, the seller's agent's most likely going to reach out to me and say, hey, where are you with this? So I have to set those expectations with the client, like, hey, I'm willing to send you the pre-approval letter, but you got to get us your stuff in an hour. And you got to do we need this application done. So by the time the seller's agent reaches out, I can go to bat for them and say, yeah, we have credit pull, we have asset information, we have pay stubs, we have verification of employment, all the things that we do, So yeah, it's not to say we're flexible. It's not like, hey, they haven't done it, I'm not sending anything. Like, I'll work with you guys, but they got to understand that they're trying to purchase their biggest asset and they have the largest financial transaction of their life. They got to understand there's got to be stuff that goes into this. So
cool. So it is possible. It's just it's like worst case scenario, but it is possible.
Yeah, I mean, okay. Look, we don't want to make a habit of it, but if somebody looks like a rock solid buyer and a borrower on our perspective, yeah, I mean, I'm not going to hold you up from putting in an offer. It's just, you don't want to. I've had circumstances in the past where realtors have really pressed me to get pre-approval letters, and then all of a sudden I'm getting a call from a seller's agent, and it's kind of like getting caught with your hand in the cookie jar. Like, yeah, they're okay, sure, they're good to go. Yeah, okay, sure. That's not that's not the reputation that I've built. That's not how we want to operate on a regular basis. But again, if it's something that looks like it's rock solid and on paper and in theory, I have no problem sending that letter with the assumption and the caveat that, hey, we still need XYZ with these people. You know what I mean?
Cool. Okay, cool. Thanks.
Yep. Any other questions regarding this stuff, guys? Nope. Good. Good. All right. Let's dive into appraisal shortages. Also, if you don't say this sentence with like an accent too, I don't know what you're doing, but so appraisal shortages, what is it? So basically, big part of the market right now, and you guys may recognize this from the buyer battle plan, but this is a good, awesome slide that Mr. Gilly and myself put together. Mark Gilmartin, that is, not the puppet master Gil. Basically, almost every single appraisal that we're getting back, like I said, probably 85–90% of them are coming back light in some fashion. That may be $5,000, that may be $10,000, that may be $25,000, $50,000. So we have to have a plan in place of how to deal with that if and when it does happen. And it goes back to what I'm saying as far as education purposes and educating clients. Very important that they understand that this may be a reality for them. And if so, what are we going to do about it? And this is going to separate yourselves from other realtors too, understanding this, being educated on it. Like, Jill and I had an example where we were on the phone at 9:30 at night talking to a seller's agent, and his concern was a light appraisal. And what are we going to do about it? And I educated him on it and told him, hey, the buyer's willing to do this. Here's the situation. And he understood it, and it cleared his head of it, and they accepted the offer. And that deal's closing shortly, right? Next week or something, right?
Yep,
So,
we are. Yep.
And we did have a light appraisal on it, and it was a very, very easy issue to rectify, because the client was educated on it and she understood, hey, okay, it came back, here's your options. And it was that easy, as opposed to scrambling like, oh shit, what do we do now? You have a plan in place, you have contingencies. So in essence, and if you guys have seen this with the buyer battle plan, but in this particular scenario, we're saying this, Walnut Street and Wall, asking price of $450, offer price or offer that was accepted was $50,000 over asking price. Big shocker. That would be kind of a win in this market if you got it only $50,000 over asking price. But anyhow, so when we get the appraisal back, let's say it comes back and it appraises for $475. So at that point, we have a $25,000 gap we have to deal with. So what's going to happen here, and again, let me preface this by saying clients that are putting down 3% or 5% and don't have any more money than that, in reality, it's a harsh reality, but they're going to have a very difficult time purchasing a property right now, which is why first-time home buyers have gotten shoved out of this market rather quickly. So again, I have those conversations with clients right up front. Like, hey, you're in a tough spot. If you got 15 grand to your name and that's all the money and you can't get gift funds, you're in a tricky spot in this market. It's just the reality of it. But somebody that's putting down, let's say 10% or more, is going to have some options. So scenario one, they come out of pocket with roughly the $25,000 appraisal shortfall. Now, when I say roughly, it's not exactly 25,000. It's probably going to be somewhere in the neighborhood of 23,000 or somewhere in that vicinity, because it's based upon the LTV of the appraisal, basically. So it'll be somewhere within that range. If they understand that, they're willing to do that. And this particular scenario, by the way, was with somebody putting 20% down. Should mention that. If they're willing to do that, just cover the gap of the appraisal. They're going to maintain their 20% down payment. Nothing else is added. Everything else in the file is going to stay the same. Their payment actually is going to be a little bit lower because technically they're borrowing a little bit less money, because we're only lending upon the value of the 475. So that would be option one. That's like path of least resistance. They're going to put the more money in. Scenario two would be they're going to scale back their down payment to cover the gap in the appraisal. What that means is instead of putting down 20%, maybe they put down 15%. So, the 5% of $100,000 down payment is 25 grand. That closes the gap for the appraisal. Now, obviously, the file is going to change slightly. They're going to now have some type of mortgage insurance added. There's a couple different options for mortgage insurance. The most common one is monthly. And in this particular scenario, their payment's going to go up roughly 30, 40 bucks a month. So again, you explain this to a client and they're scared shitless of, oh my God, what do I do with this $25,000 gap? You explain it to them. Hey, no problem. We're going to scale back your down payment. Oh my God, but I have mortgage insurance. Okay. Your payment is $35 higher. Are you still breathing, Mr. Jones? You explain it to these people like that, it puts it in context. Okay, that's it? That's the only difference? Yes. Okay, good. All right, so we're good then. Yes, we're good. No problem. Okay. And again, all this stuff is explained way ahead of time prior to the actual appraisal being done. Other options would be upfront mortgage insurance or financed mortgage insurance. So let's just say the upfront mortgage insurance is going to be $2 grand. So they would have the option to bring the additional $2 grand to closing to wipe out the monthly, $30, $40 monthly. Or they can also finance mortgage insurance, finance a $2,000, $3,000 policy, which may only shift their payment even less. So again, I'll run through these options with them, but very helpful to know this stuff. And again, leave it to me to educate the clients on this, because again, it's funny because Gilly and I are running through these scenarios, and he's like, what do I do if I'm in a driveway with the client and I'm trying to explain this? So I think this slide really is very helpful to leveling the playing field with this. And very important stuff to know, again, because if there's an offer that's being entertained and we can talk to the seller's agent like this, because their question is going to be, all right, are you going to waive the appraisal? Again, waiving appraisals is a little bit more of an art form. It's funny because a lot of clients are like, yeah, I'm just going to waive the appraisal. I don't need an appraisal. I'm like, time out. That's not what that means. It means you're waiving your right to negotiate if an appraisal comes back light. So a lot of times, I'll recommend instead of waiving the appraisal completely, put a threshold in there. For this particular property, maybe they say, all right, we're going to still buy the property if it appraises for, 460 and above. So that way you're setting a limit. You're limiting potential damage from an appraisal being light. But it's a very common thing. I mean, I'm sure all of you guys that have had offers accepted have been waiving some type of inspection contingencies or appraisal contingencies. That's just a very common thing. It's almost an automatic thing that sellers want to see right now. So, any questions regarding this stuff here?
Yes,
Regarding,
me, I do. I think I had the exact question we were at the presentation you gave.
yep,
I got stuck on that mortgage insurance last time too. So that 2,000, that's not the gap, obviously. That's just this extra mortgage insurance, and you can have the option of spreading it out monthly, or you can bring it to the table.
correct, yes.
And does it go higher than 2,000?
It depends on a couple factors. It depends on the person's credit scores and exactly how much money they're putting down. You know, so if somebody was putting 10% down and they're scaling back to 5%, the mortgage insurance is going to be more expensive because it's a higher risk. They're putting down less money. It's all risk-based. So if somebody has a 690 credit score as opposed to a 750 credit score, their mortgage insurance is going to be more expensive. So
Okay.
it's not a cookie cutter situation. I'm just using this as a general example of somebody that has good credit, was putting 20% down, in essence, is what you're looking at here. Yeah, I mean, if somebody has crappy credit and is putting less money down, their monthly mortgage insurance may be, you know, $80, $90, $100, but it was already going to be higher to begin with. You know what I mean? If somebody was putting 10% down, and they had crappy credit, their MI monthly is already going to be, you know, whatever it looks like, $100 or something along those lines. So if we're scaling them back to 5%, their MI might go to $150. Point being, it's only going to change the file incrementally to get the deal done, regardless of the situation. You know what I mean? Yeah, Luke.
Hey, so there's a lot of people that are, you know, you have to kind of, you know, make your offer stand out. So a lot of people will put, you know, instead of like a full appraisal waiver, they'll put, you know, $40,000-$50,000 gap, or, you know, whatever it is. And, you know, you do your inspections first, you get their inspections, and then say your appraisal comes back with that $50,000 gap. And then the buyers are, you know, if they've had about a month now to kind of sit on it, and they're like, well, you know, I don't really know about this. And they don't want to do that. Since it's in the contract, can they get out of it without losing their deposit? Because now they're kind of going against the contract, right? Or does it then fall on that they can't get a mortgage commitment, and then it gets killed from that? You know what I mean?
Yeah, it's kind of a two-pronged question, really. I mean, as far as them being able to get out of the transaction, I mean, look, they're in New Jersey, buyers are very protected and can wiggle out of transactions almost at any point. And it also goes to say too, like, you know, even if they were ironclad in the transaction and they're trying to pull out, it just depends on the situation and on the attorney. But technically, by the law, if they agreed to, hey, I'm going to cover this gap, and it comes back and it's at the max gap they agreed to cover, they have to have a solution for that. You know, a lot of times, most likely a seller is not going to accept it until they see, hey, do they have proof of funds to cover that? Or do they have a mortgage option if that happens? And then it's for us, again, like, I'm the one going to bat and saying, yeah, we have options if it comes back light. So it's tough for us to then turn around and say, yeah, we're going to deny the mortgage. You know what I mean? So it's all about educating the clients up front. And, you know, they can't have buyer's remorse a month into this thinking that they're going to wiggle out of it from having a light appraisal, which we already told them was a very good possibility. You know what I mean? It's all about setting the expectation for the client.
Cool. Okay.
Does that make sense?
Yeah. Thank you.
Cool. Anybody else?
Hi, Evan.
Hello.
I have a question.
Sure.
I had those buyers for about 3 months that I've been trying to find them a house.
Mhm.
When we first started, the interest rate for them was 3%. As of I know, I believe today it's 5%.
Correct.
So I've been looking up different options for them, and I came across to the ARM mortgage. What do they need to qualify for that? And do you recommend it?
Well, first of all, I would stay away from looking up financial possibilities for your clients. Leave that, usher those questions to me or have them come over to me so we can break this down for them. Because again, the last thing you guys want to do is get out of your lane and veer into starting to give them mortgage advice, because they may be like, oh yeah, I want an ARM mortgage. And then they talk to me and their credit might not be good enough for an ARM mortgage, or it may not make sense. There's a lot that goes into the pre-approvals to get them to the point of qualifying and then seeing what products make sense. So yeah, I mean, ARMs are coming back a little bit because there's just such high turnover in mortgages in general, but there's qualifications for them. So it really depends on each and every person and what their goals are with the property. But yeah, whenever rates go up like this, they do creep back into the market. But as always, like anything specific like that, have them contact me directly and I can walk them through it. Because
yeah, I didn't bring it up to them. This is something that I looked up for myself.
Gotcha. Yeah, absolutely. No, I mean, it's certainly, and we can talk about it further if you want to call me directly for sure. And I can, educate you on that. But yeah, I mean, look, it's a tricky market because, again, rates were 3.25% around Christmas and rates are 5% right now. So, any way you cut this, and I think I have an actual slide in here for that. I believe yeah. This is a good example. This was on the left column here was Christmas time, and here's where we're at now. So, again, payments going up $400 for a similar, same exact scenarios here. So it's part of the market that you have to deal with. I mean, so, it's theoretically, that's the first question people ask me, is this going to, really dip property values? Is it going to put a pause on everything? My answer is absolutely not. I think there's way too much demand and way too little supply. And that obviously interest rates going up have not stopped people from throwing in crazy offers on properties. So.
But do you think with the interest rate going up, the competition will get less and the house prices will kind of not go crazy as like right now? I'm seeing like I'm putting offers 40 plus over asking for my clients and I'm still losing.
Yeah. So, I mean, the short answer is no, I don't think it's going to affect it.
That's the answer to your question. It's just like if there's a line of people, to buy the house, and the first 5 people in line all have cash. The next 5 people in line have 20% down and 50 grand to cover appraisals and don't care about inspections. The next 5 people in line have whatever. And then there's in the back of the line, there might have been 40 people in line behind them at Christmas time. And now there's only 15 people behind the line right there. But like for every house that pops up, each of those, the buyer pool is still significantly deep where it's still extremely competitive right now. And until that balance gets up where like when a house comes up to market, there's only 1 or 2 people in line to buy it and they're at 20% down and not willing to do inspections and stuff. You've got to just think about that dynamic at each house. Just because the rates are higher now, there's still people that are willing to pay the same price at the higher rate and eat that extra monthly payment in these markets. And it's just a matter of trying to keep your ear to the ground, be on calls like this to start to hear these, pieces. There's little signals in the market that we start to pick up on. Nobody has a crystal ball. But you're just, things will shift sudden, gradually, or you're trying to just be in tune to those things as best you can to be as fast as you can in the process. But right now, you answered your own question where you're putting 40K over and still losing. I don't know what price point you're talking about, but that for that property in that market, that's the answer.
Of course, it's the 450 that everybody has the same.
So at that price point in your market right now, wherever that is, it is still extremely competitive. So the takeaway is that you just need to be prepared and educated to have the conversation to guide your clients who are hearing on the news that interest rates are now 5% and oh, interest rates went up, so the housing market will crash. You'll see headlines, housing market crash coming. And what you're seeing in the ground is actually still the opposite of that. So that's how you provide value to those clients, is get their head straight about what's really happening and why, and how it's different than in 2008 and
Yes.
all those things. That's why you need to understand what's going on and be aligned with somebody like Evan, who can then kind of guide them through what's what and understand that, okay, if you still want to buy a house, it's still extremely competitive. Or you can read what's on your AOL.com news feed and never buy a house.
Yeah, the biggest thing to note is that Gil mentioned it's not 2009, and the biggest difference is that there's it's supply and demand. In 2009, everyone was getting foreclosed on because people were lent bad money and should not have been given mortgages to begin with. They couldn't afford them, and they were foreclosing on properties, which led to a huge, a massive swing in supply. There were a lot of homes to be purchased, and there wasn't a lot of demand because there was a financial crisis. So it tipped it the other way. So what happened? Property values dipped 20, 30%. We're at the other end of the spectrum right now. We're in a housing crisis. There's not enough homes for people to live in right now. That's the sheer fact of it. And to get on the other side of that, it's going to take time. Because like Gil said, there's a line of people waiting. Okay, rates went up and it bumped out half of that line. Guess what? Now there's 10 people instead of 20 people that are still willing to buy the house, even at the inflated interest rates. So it hasn't stopped demand, just because there's such little supply. So that's kind of what you're looking at. But
Thank you.
yeah, so I know I only have a few minutes here, but I'm not going to get into a whole conversation about rates. We can, again, that's another hour-long training I could do just on interest rates alone. But again, this is the jump that we've seen, and what the other good thing about this slide too is educating your clients of, hey, all right, this is the same scenario, $500,000 purchase, but now they're offering 520. What happened to their payment? Their payment went up $90. So again, putting that in context to your clients, because they're going to be kicking themselves with their dream house, and they lose it over 20 grand. I'm not saying 20 grand is not a lot of money. It's a lot of money. However, stretching it over a 30-year period into a mortgage, we're talking about $90 a month. So, don't go out to dinner one night a month if you want to get this house, and it's going to cost 20 grand more. So it's a way to put in perspective for your clients, like, you got to get aggressive. Of course, set boundaries, set parameters. You don't want to bite off more than you can chew, and be worried about how you're going to make payments, because again, we're qualifying things based upon people's credit reports. I know there's more that people are spending money on outside of credit reports. I got 2 young kids. They're a fortune. There's things that, daycare, everything, involving children, anything outside that's not shown on a credit report. So setting parameters, setting expectations is important. But again, talking about somebody that this may have got them the house offering 20 grand instead of 500. So again, something to keep and put in perspective. And I know I only have 5 minutes, so I'm not going to dive into this. This is a whole nother conversation. Anybody that wants to contact me directly.
Yeah, I'll give a plug for the CE class that you guys did. This is my first exposure to equity prime. Before I was, like, the minute I was licensing, before I partnered up with Joe, I sat through this course that was run by Equity Prime, and it was super informative and awesome, and a really cool option to build wealth and create value for clients and things like that. So whenever that, do you know when the next time you guys are doing that is?
We can set something up. Now that the world's reopened, we're getting back into it. But yeah, I mean, in essence, very simply, renovation financing is, the simple definition of it is you're being lent money based upon what the future value of the home is going to be once the repairs are completed, or after repaired value. So, we're lending, somebody's buying a house for 300,000. They're doing $50,000 worth of repairs. We're going to lend based upon the value of that home being 350 or more moving forward. So again, as Gil mentioned, it's a 2-hour CE course. So trying to go through this in 2 minutes is worthless, but just wanted to touch on it as an option, because the big thing to note with this is that it's very useful if you have an appraisal that comes back subject to, if you have repairs that need to be done on a property. Ethan had a buyer that the home didn't have heat for whatever reason. How they didn't have heat and we're living off space heaters beyond me, but that would have been a perfect situation for renovation financing, where we know, okay, it's going to get 10 grand, 15 grand to repair the home and get the heat in there. You set it up as renovation financing, you close, the work gets done post-closing, done deal. So it's a solution, it's a tool to have. And again,
Evan?
Yeah.
Is there a max on that repair stuff?
Well, you'll see here, full renovation financing, full 203K or home style is going to be 30 grand or more. Anything below 30 grand is considered limited. So there's not necessarily a max. The problem with full renovation financing is having the sellers accept it, because it's going to be more of a lengthy close. It's going to be at least a 60-day close. So a lot of sellers are going to have trouble entertaining that right now. So unless the house is in such disrepair where it's not livable, then you got a shot. And it's not, there's not a ton of offers being made, that's more so for a full renovation. However, limiteds are certainly possible. If somebody wants to redo a kitchen, they love everything about the home except the kitchen, this is a great opportunity for that, because then it's something that we can close on in a regular closing period. And then they get their dream kitchen and it, plugs it into the house they already love. So again, just wanted to bring it up as a tool in your tool belt, so to speak. And again, anybody that wants to go through this, I can walk them through it in separate phone calls, since we're basically out of time. But
yeah, Evan, I just saw that Luke had his hand raised. I know we have like 1 more minute, but Luke, did you have a question before we hop off?
Real quick. Yeah, real quick. Because there's a lot of people too saying like, oh, interest rates are so high. And I kind of tell them like, I don't know, since you've been doing mortgages since, 2004 or whatever, what's kind of the average rate you've seen? Because I feel like rates are kind of getting back to normal, not so much high. They're not COVID low, What's an average rate you've seen since you've started?
yeah, I mean, it's a great point. I bring that up all the time. Anytime somebody's going to tell me that, the interest rates are, and I'll show you this real quick before we're done here, but anytime somebody's going to tell me that interest rates are high, I'll go to this chart and I could pull it back to 5 years. And in 2018, rates were 5%, end of 2018. So, we're talking about 4 years ago. So, people are just brainwashed to think that rates are 2.75, and it's not reality. So to say that a 5% rate is high, guys, talk to your parents who bought houses in the 80s. Look at this. 16, 17, 12% interest rates in the mid 80s. So it's all perspective. Just people are brainwashed to think that 275 is where it's at. And again, I'm a big proponent of it's about payment. It's not about rate. When you're making your mortgage payment, I'll leave you with this tidbit. When you're making your mortgage payment, you're not writing your interest rate on the check that you're writing for your mortgage payment. What are you writing? You're writing a payment amount. You're not writing a rate. So it all goes into the payment, not focusing just on rate.
Do you see the rates going up more?
I think we're trying to hold ground here at the 5% threshold. As far as how high they're going to go, I mean, you'll see here his national average is here 5.08 with 0.4 in points. But me personally, I think we're probably going to be low fives, mid fives, and I think we'll probably plateau there. And then, in my professional opinion, I mean, we're heading towards a recession without a doubt. So that tends to historically pull interest rates a little lower. So I think towards the end of the year, we may see rates regress a little bit. into the beginning of next year maybe. But when I say rates regressing, I'm talking about getting back to, 4% flat, maybe high threes. I think the days of the 2% mortgages are over. That was just historic. So, but, again, that's all mortgage planning perspective.
Hey, Evan, thank you so much for hosting today's training. I really appreciate it, and thank you everyone for attending.
Thank you.
Thank
Thanks,
thank
Evan.
you, Evan.
You got it.